Is a crash in the real estate market imminent? And more importantly, what does the data say? Because I think that this is a question that is on a lot of people's minds. What makes this question difficult is that you have very smart people on both sides of the aisle. You have economists who think that a crash is imminent, and you have economists who think that a crash is nowhere in the near future. So instead of giving you another opinion, let's go over the data line by line, and let's compare today's data to the data from 2008, which was the last major real estate crash, and let's see if history can teach us anything about whether a crash is imminent or not. All right, let's get right to it. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's go over the numbers. So first and foremost, the first number that I want to go over is a number that relates to affordability, and that is price to income, the average price of a house to the average income of a U.S. employee. In 2006, which was right before the crash, that number was 6.8. That means that the average house cost 6.8 times the average yearly salary. In 2023, affordability has gone down. That number is 7.4 and is probably going to push 8 very, very soon. That means that today it takes 7.4 years to cover the cost of the average house. So the first piece of data shows us that affordability is down, which would be a negative sign for the real estate sector. But at the same time, it also means that housing prices are higher, which can signal what? It can signal strong demand. Okay, so that's the first piece of the data. The second, and I think this one is very important, in 2008, we know that foreclosures were a major driving force to causing the crash. So in 2008, 1.8% of all housing units in the United States experienced a foreclosure. Okay. In 2023, that number is 0.13% for the first half of 2023. That means that it is more than 10 times less than the number in 2008. That signals strength for the real estate market, and that signals that a crash potentially is not in the near future, because foreclosures can be related to people's abilities to purchase houses and afford them. And when affordability goes down and people cannot afford monthly payments, a foreclosure is initiated. When a foreclosure is initiated, it is a twofold problem. One, it signals weakness in the market. Two, it brings more supply online. More supply, then demand, and prices come down. A lot of things in economics can be simplified to supply and demand. Okay, so foreclosures seem positive for the current market. Now, what about the unemployment rate? Because again, if people do not have jobs, they cannot afford houses. If they cannot afford their monthly bill, foreclosures happen. In January 2007, so right before the crash, that number was 4.6% unemployment rate. That number rose to a whopping 9.8% in 2009. Okay, that is very high for US standards, and that would be considered high unemployment. Currently, the unemployment rate is 3.8%. It was around 3.5%, which are both very low numbers. The reason it has creeped up a little bit is because the Fed is, of course, fighting inflation. When the Fed raises interest rates, the economy shrinks and the job market leans on the brakes. That is a natural thing we all knew that was going to happen. But 3.8% is still very low unemployment. All right, so that is a positive for the housing market because it means that people who do own houses are more likely to be able to continue to afford their properties, which means that there is less likelihood of foreclosure and an eventual domino effect and a collapse. So far, price to income, it is less affordable. Foreclosures, there are less foreclosures, and unemployment is significantly lower than even 2007, which right before the crash, things seemed to be okay. Okay, what about inflation rates? Because we know that currently inflation rates are a major problem, and it is part of that problem is housing, whether it be rent or whether it be owning a home. In 2008, the inflation rate, so 2008 is when the crash initiated, that was 2.5%. So basically right on the money for the federal target rate. The Fed wants inflation around 2%. So that's right on the money. That did increase in 2011 to above 4%. Okay, but compare that to today. So last year, 2022, inflation was 8.3%. That is very high, and that is one of the reasons why Americans are feeling poor, because wages are not keeping up with inflation. And that is something else that we need to talk about. Okay, currently inflation has come down to about 3.7% via the most recent inflation report. 3.7% is still high, and it is still above the federal target rate of around 2%. So when it comes to inflation, inflation was significantly lower in 2008 and during the crash than it is now. Now, while that might look like a negative on paper, it also means that the economy is, in a sense, strong. You rarely do you see inflation and economic collapse or economic shrinking. The instance that you do see that is known as stagflation. That is a very dangerous problem because you have economic shrinkage and inflation coupled together. Last year, a lot of people, myself included, thought that stagnation might take place. As we move forward, that seems less likely, at least for the near term. Still a possibility for the midterm. But that is topic for another video. The point is, inflation is low. Okay, at least compared to, inflation is high, at least compared to 2008 and for the federal target rate. The next thing, the average household income. And this one's important to compare to the following thing because this shows you where there is a disconnect in affordability. So the average household income in 2008 was right above 50,000. It was 50,303. Fast forward to today, 2023, the average is around 74,580. So we did see an increase. With that said, that's about a 50% increase in income. When you compare that to the next thing I want to talk about, which is the average home price, you see why affordability is so low. The average home price in 2007 was $246,000. Currently, the average in 2023 is $430,000. So not quite a doubling, but remember, the peak of the real estate market was actually early last year. So almost a doubling. So you have a 50% increase in wages, but you have very close to double the increase in home prices. That is why affordability, the first ratio that we talked about, price to income, is so bad. All right, the last thing I want to talk about, and I think that this is the most important piece to the puzzle. And while data is all very important, I did foreshadow earlier in this video that a lot of things in economics can be broken down to supply and demand, at least when it comes to price movement. In general, if supply is above demand, prices fall, unless the market is being manipulated. In general, if demand is higher than supply, prices increase, unless there is manipulation in the market. In 2008, there was more supply than demand for a couple of reasons. One, there was an overbuilding that was leading into the crash, all right, because real estate was so hot. Two, when people started foreclosing, that increased supply dramatically. And on top of that, you had a decrease in demand because people's ability to buy houses went way down. So in 2008, you had an oversupply and an under-demand situation, which is primarily, no matter all the inputs, that is what caused prices to fall. And that is what causes prices to fall in general. Currently in 2023, I believe we are having the opposite problem. We have an over-demand and an undersupply for a multitude of issues and a multitude of reasons, which I've talked about in previous videos. But the fact of the matter is there is undersupply in building, there is undersupply in houses coming online because people are basically rate locked at 3%, 4% mortgages, and mortgages have gone so high so fast. There was no time for a lot of these people to adjust. So people who want to buy a house right now or who can afford more house, the current house that they're in, they're stuck in because the next rate that they would get, the next mortgage that they would get, basically means that they would be able to afford less house, not more house, for more money. So you have undersupply because you have supply not coming online and you have an underbuilding. There are other issues and other problems that are also exacerbating the problem, like corporations buying properties, like corporations shelving properties, which increases rents. There's all those other problems that are major problems that we do need to talk about in a future video. The point, and I don't want to drag this on too long, the point is currently we have undersupply and overdemand, which seems weird because you'd think that with high interest rates and high prices, there would be less demand. And there is. There is. The problem is there is also much less supply. So you cannot just look at demand or supply. You have to look at both sides of the equation, and you have to see it as a scale or a balancing act. When there's when there's more of one than the other, the prices will fall in that favor. That is simple economics. You don't need a degree for that. That is just, if there is no market manipulation, that is how supply and demand works, and that is how pricing works. So, in my very humble opinion, because I do not think I'm I don't think I'm the smartest person in the room, and I don't think I'm smarter than you. I just can pull from my experience, I can look at the data, and I can provide you with the data based on my education, my degree in finance. That's it. But like I always say, I want this channel to be a discussion. I want this channel to be an open discussion. So if you have differing opinions, or if you feel like I missed something, please put that in the comments. But in my humble opinion, I do not see an imminent real estate crash anywhere in the near future. Now, can that change? Yes. What would cause that to change? The major drag that we're seeing right now is wages are not keeping up with inflation. So if the Federal Reserve cannot get inflation under control, that means rates are going to have to go up, which means affordability in houses are going to come down. If the Fed cannot get inflation under control, that also means that, and wages stay low, that means that the gap between inflation and wage growth increases. And the larger that gap is, the more people have to be conscious about what they're spending their money on. Okay, this is a vicious cycle, because when people are more conscious about what they're spending their money on, they are spending less on luxury goods and tech, etc., subscriptions, and they're spending more on essential goods like food and housing. So when that gap increases, eventually something snaps, because if prices for everyday goods keep going up and up and up, and wages do not keep up, there's going to come a time where the average person who is in America is living paycheck to paycheck. There's going to be a time where their paycheck cannot cover their bills and cannot cover their mortgage. And at that point, you may see an increase in foreclosures, which I do want to touch on. While foreclosure rates are much lower than they were in 2008, they are ticking up. I didn't have this on the data that I wrote down, but I did see that foreclosure rates are slightly going up, okay? Because people are having a hard time affording life. So in my opinion, I don't see a crash imminent. I don't think that a crash is going to happen in 2023, and at least based on the current data, maybe not in 2024 either. But I do see problems and I see headwinds, and I think the major problem is a disconnect between affordability in everything and wage growth. And eventually, we keep pushing this boundary, and eventually things are going to snap, and more people are not going to be able to afford daily living. And that is when you have a cascading effect, especially if that happens relatively quickly or in a short period of time. So we have to monitor, we have to watch out, we have to see, we have to look, but at the same token, okay, there are a lot of people who call for doom and gloom, and I understand that that is the culture that videos are and that media is, because you have to get people to watch your video. But at the end of the day, I want to provide you with the facts and the data. These are the facts, these are the data. This is my humble opinion. I would love to hear yours in the comments. I hope this video was informative, and I hope this video was helpful. If it was, please consider subscribing. This is a relatively new YouTube channel, and it is something that I'm very passionate about. So if you love personal finance, world economics, financial news, broken down into simple terms, and if you like having a discussion about it, you're in the right place. So please consider subscribing, and don't forget to turn on the bell notification. New videos usually come out on Tuesdays, but sometimes there's a major event and a video might come out on Wednesday, Thursday, or Friday. Other than that, I hope you have a great rest of your day, a great rest of your week, and I will see you in the next video.